Australia's property market has once again proven its resilience, bouncing back from a short-lived downturn faster than many expected. Throughout 2025, multiple uncertain factors, both positive and negative, will emerge in the coming months. Each factor will profoundly impact Australia's property market, and once all these forces combine, how will the housing market perform for the rest of the year? After watching this episode, you will find the answer. Let's adjust the property investment plan for the whole year, avoid traps, and make some profits. Hi, I'm Alex. Welcome to Aus Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. If you've been following this channel, you probably still remember that December last year was the first month Australia experienced a decline after 22 consecutive months of gains, dropping 0.1%. At the time, I mentioned it could signal the start of a downward trend, but also said not to worry too much. December marks the end of the year, and January is the start of the new year. So combining data from these 2 months is generally more effective when we analyze the market. Waiting for the February and March data will provide an even clearer picture of the year ahead. Right after I said that in the last episode, we got the January data for the housing market. The national index turned to zero, meaning housing prices neither rose or fell in January. Of course, it's still too early to conclude whether that can form a lasting trend. After all, the December and January data aren't that reliable when predicting the market in the new year. In January, Sydney's downward trend slowed slightly, easing from a single-month drop of 0.6% in December to 0.4%. Any monthly market change within plus minus 0.5% is considered a flat period under Aus Property Strategy's investment framework. December's market move exceeded that range, whereas January returned to a flat period. Whether Sydney's 2025 housing market has halted its downward trend or will follow Melbourne's path over the last 18 months into a flat period still needs ongoing observation. Melbourne's January housing market decline also eased from a drop of 0.7% in December to 0.6%. Although the downward trend softened, it's still clearly in a declining cycle. Melbourne's housing market has risen for 23 consecutive months and entered a flat period in December with a 0.5% increase, indicating a slowdown in price growth. This trend continued into January this year with a 0.3% rise. Adelaide has seen 22 months of continuous growth. After a 0.6% increase in December, January showed a small rebound at 0.7%. It's not possible to determine whether Adelaide is about to embark on the next round of accelerated growth. We'll have to wait for the February and March data before drawing any conclusions. Perth's housing market has climbed for 22 months and, in January, entered a flat period for the first time, with a monthly increase of 0.4%. Perth's growth rate is also slowing like the other two mid-sized cities mentioned above. Over the past 2 years, these 3 cities' property markets have experienced a massive property boom, with the median prices rising by about 65%. Naturally, people will say, they've risen so much and they won't go up any further, right? I was asked this question 24 months ago, 18 months ago, 12 months ago, 6 months ago, and people are still asking now. My answer has always been the same. If you're buying a home to live in, any market entry point is a good point. After all, you're going to live in it for 10 to 20 years, so timing isn't that important. What matters is whether this property meets your daily needs like commuting, shopping, groceries, schools for kids, and so on. If you're buying an investment property, you absolutely need to look at the long term, 10 to 20 years. The entry point doesn't really matter. If you get in with good timing, great. If not, no worries. It's the holding period that ultimately determines whether you profit. If you want quick gains and overnight wealth, you'd be better off trading crypto. Someone might say, what about investing in stocks? That's fine too, but Australian real estate can get you 4 times leverage safely, and its long-term average returns beat stocks hands down. If your goal is to earn the market average and keep doing that for a long time, then it doesn't make much difference which city you buy in. The crucial thing is having a well-structured asset portfolio that fits your personal wealth plans. The property markets in Australia's 3 small cities, Hobart, Darwin, and Canberra, are still in a flat period. I've given it a name, volatile flat, meaning that each month rise or fall is within plus minus 0.5%. But we can't tell whether it will be up or down by 0.5% next month, because there's no trend. For those watching Aus Property Strategy channel for the first time, I'd like to add one more note. The Australian Property Market Index measures the average rise or fall in property prices and doesn't represent every individual property. Australia's housing market index cannot stand for the property market performance of every city. Similarly, Sydney's market index can't represent the ups and downs of every suburb or each house. The index can only give us an overall impression. Individual properties need to be analyzed on a case-by-case basis. The above shows each city's month-to-month housing market movement. If you want to see the trend, the best approach is to look at 90-day trend chart, because when the time frame is extended to a quarter, the ups and downs aren't as sharp, making the trend clearer. From the chart, it's very clear that the medium-sized cities are all in a rising stage, but their upward momentum is gradually slowing. Cities below the zero line include Sydney and Melbourne, yet the downward trend has slightly eased. In the chart, Hobart is below zero but has not shown any trend over the past 2 years. Hobart's housing market has been jumping around close to positive or negative zero. The 4 small green circles in the chart represent the 4 times in the past 3 years when Ozproperty's strategy made forecasts about the market's overall direction. Now it seems they were all correct. Australia's rental market has continued its long-term trajectory and it's still on the rise. However, besides Darwinist's accelerated rental growth, every other city's rental increases have been slowing down. In terms of rental yield, there hasn't really been any change. Darwin is still the highest in the country at 6.7%, the lowest is Sydney at 3%, and the national average is 3.7%. Rental yield, also known as the rent-to-price ratio, refers to 1-year total rent divided by the property price, without subtracting costs, so technically it's the gross rental yield. The good news is that Australia's inflation has declined very noticeably and has now entered the ideal 2 to 3% range. Signs of a rate cut are quite clear. It's simply a matter of when. When looking at Australia's economy and housing market from a higher, broader perspective, you must consider global factors. Though there may not be a direct effect, indirect impacts will arrive sooner or later in Australia. International trends are beneficial for viewing Australia's housing market 6 months or more into the future. There have been some changes in the US economy. Core PCE has stayed at around 2.8% for 3 consecutive months, not dropping as expected. In fact, core PCE for the 4th quarter of 2024 even rose from 2.3% to 2.4%. Public opinion has now begun worrying about a rebound in inflation. Adding in the January unemployment rate drop to 4%, good for employment, but indicating that inflation has stopped falling and slightly rebounded, it shows that a high interest rate environment is very much needed. Therefore, at its most recent policy meeting, the Federal Reserve's decision to keep rates unchanged was very prudent, and the market now expects a 92% probability that there will be no rate cut on 19th of March. Up to now, the world's most influential countries have been in the rate cut cycle for some time. Some countries have even begun a pause in cutting rates, indicating that everyone is starting to worry that under President Trump's future administration, various policies, including tariffs, may spark domestic inflation in different countries. Obviously, continuing to cut rates isn't ideal right now. It's better at least to prepare in advance and remain steady first. If you've been following the news lately, you've probably heard the word tariff more than enough times in the past month. Many people worry about negative impacts on Australia's economy but can't quite grasp what those impacts might be. Let me break it down for you. It's actually pretty simple. Just compare Australia's exports to the US with their exports to Australia. Once you line them up, the result becomes clear. First off, Australia runs a trade deficit with the US. For example, Australia might export $100 worth of goods, while the US exports $200 worth back. In US-Australia trade, the US is already coming out ahead. President Trump's policy logic is based on fairness, citing unfairness to justify new tariffs, using tariff threats as leverage to negotiate with other countries. Yet in US-Australia trade, the advantage belongs to them. In fact, they should be in favor of Australia imposing tariffs on the US to lower their export volume if they truly want fairness. There's no reason to single out Australia with punitive tariffs. Second, the volume of goods that Australia exports to the US is far too small as a share of US imports. The top 4 are the European Union, Mexico, China, and Canada. Now you can see why the first wave of tariffs targeted them. What I can imagine is that if the US imposes a globally uniform tariff on a particular category of goods or applies universal tariff to all countries, then it might affect Australia to some extent. However, the single largest category of Australian exports to the US is meat. If the US places a tariff on this type of product, Australia's meat exports would decrease. However, these agricultural and livestock products can easily find alternative buyers. So the impact on Australia's international trade would not be that significant. Australia's exports of iron ore, coal, and natural gas to the US are almost negligible. Therefore, tariffs won't directly affect Australia. There's an indirect impact that could be transmitted to Australia through other countries. Under increased US tariffs, other countries will likewise impose more tariffs on the US, raising global tariff barriers and reducing the efficiency of trade. For instance, if it costs $20 to manufacture a doll in China and it's sold to America with a 100% tariff, the end consumer pays $40. The same item becomes more expensive, value vanishes into thin air, production efficiency drops, and the total wealth naturally shrinks. Countries affected will see their economies dip, and that in turn will affect Australia to some extent. Australia's trade volume with the US, Canada, and Mexico is quite small, whereas it's large with China. Australia primarily exports commodities like iron ore and coal to China. If international iron ore prices fall, or if China's economy weakens enough to reduce purchase volume significantly, Australia will experience a short-term impact, lasting until it finds a new outlet for its exports. Does the Australian economy directly affect Australian housing prices? The answer is no. Under the Aus Property Strategy Investment Framework, no single factor can directly determine the trajectory of Australia's real estate market. Australia's GDP, for example, can't directly influence it. Despite 5 consecutive quarters of declining GDP per capita, the overall housing market continued to rise during that period. Interest rates can't directly influence it either. For instance, not long ago, Australia's property prices climbed during a rate hike cycle. Even immigration numbers can't do it directly. During the pandemic, Australia shut its borders, and though home prices briefly dipped by 2.3% due to policy shocks, they soon returned to growth. Only supply and demand directly drive housing prices, and behind both supply and demand lie numerous contributing factors. So what will Australia's housing market look like in 2025? Although by the time we wrap up this episode, we only have January's data, which is not enough to draw conclusions. It doesn't hurt to make a guess. For 2025, there are several negative factors, positive factors, and many uncertainties. For example, US tariffs could trigger inflation and rate hikes that would be negative for Australia's economy and housing market. Australia's population growth might slow down as fewer immigrants and international students arrive. On the positive side, with Australia beginning to cut interest rates, loan volumes may rise, stabilizing housing prices, combined with insufficient housing supply. There are also 2 uncertainties. One, APRA might tighten lending policies for commercial banks once it sees Australia cutting rates. And 2, we still don't know which party will win Australia's federal election. Overall, the 2025 Australian housing market will likely start off weak and become stronger later in the year, with some level of price growth for the whole year. However, the chance of a boom is relatively low. Because Australian property prices are high and affordability is low, entry-level home value might increase faster. Gross rental yield should remain steady or dip slightly. Of course, we'll only know if this is correct at the end of the year. Once we see any trends or signals, we'll share updates with our Vision members as soon as possible, helping them seize market opportunities and decide when to buy or sell. And we'll also share updates via webinars at an appropriate time. If you've made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.